Okay, well, good evening, everybody, and welcome to another one of our educational sessions here at Level Financial Advisors. And tonight I'm happy to host our tax preparation educational webinar with Lisa Merkel of Tronconi, Segura and Associates. I'm Mike Hebron, the Chief Operating Officer with Level Financial. And before we get started, just a couple of guidelines about the presentation and the way it works if you haven't been on one of these before. So throughout the presentation, you can ask questions by using the chat function at the bottom of the screen. If you enter your question there, I'll make sure to interrupt Lisa throughout the presentation at the appropriate place where we might be able to interject your question, and hopefully she'll be able to answer your question there. If not, if you would like some specific follow-up, we're going to offer, like we usually do, the ability for our attendees to text the word tax, T-A-X, to our text line, our Level text line. That's 716-727-5047. And if you text the word tax to that line, we will make sure to follow up with you after the webinar. We will send out, like we always do, a recording of the event to make sure you get a copy of that. And let's just keep it participative and make sure that everybody has a good time with tonight's presentation. So let me introduce our guest speaker, Lisa. Lisa is a CPA and principal with Tronconi, Segura and Associates, where she's worked in various roles since 2006. Her areas of expertise include individual taxation and planning, corporate taxation and planning, closely held companies and family businesses, along with Affordable Care Act consulting and compliance. Lisa received her Bachelor of Arts degree in Health and Human Services from UB and her MBA from Canisius College. Along with being a certified public accountant licensed in New York State, she's a member of the American Institute of Certified Public Accountants, the New York State Society of CPAs, where she is currently a board member and has served as a past president. So without further ado, and there's Lisa on the screen, I'm going to hand the presentation over to you, Lisa. Welcome, and thanks for doing this for us.
No problem. Thank you so much, Mike, for that nice introduction. Good evening, everyone, and thank you again to Level Financial Advisors for having me this evening. Again, my name is Lisa Merkel, and I'm a principal in the Small Business Department of Tronconi, Segura and Associates, where I've been here with the firm for about 15 years. This is my 21st tax season. So we certainly have a lot to talk about this evening when it comes to getting ready for tax season and preparing everything you need to get through to get your forms prepared and all of the statements put together and a slew of new items to be aware of this year. So let's jump right into our first slide. Okay, so we have our agenda here. We're going to talk about due dates and important reminders, income, deductions, and credits in great detail. Some New York State specific tax updates for individual taxpayers. I always want to say tax preparers because that's my world. Some basic information on gifting, wills, trust, power of attorney, and then a little peek ahead to 22 taxes, because I'm sure everyone can't wait to get started on their 2022 taxes at this point. So we have some upcoming tax deadlines. People all over are using the term new normal in relation to different phases of the pandemic we've been through. It's almost comical how many new normal scenarios there have been. At one time, many of us thought wiping down every item in our grocery bags would be the new normal, but thank goodness it is not. One new normal we tax accountants are certainly aware of is the never-ending gifts from the IRS in the form of tax law changes and changes to our tax forms. So you know what they say about Buffalo weather, just wait 10 minutes and it will change. That seems to be the new normal, definitely with the IRS. Wait 10 or even 5 minutes and the tax law will change. We've certainly seen that in the past month or so. Hence the reason my office outside my door is very busy this evening with tax preparers bustling around and working very hard. But since the pandemic started, it's really just been a whirlwind, to say the least, as many of my accountant colleagues would agree. With that being said, in terms of new normal for this tax season, we're back to normal, as of today anyway, with regard to the tax return due dates. The IRS has not extended the 1040 due date like it did for 2019 and 2020. You'll see here that your individual income tax return is due to be filed with the IRS by Monday, April 18th. So why not Friday, April 15th, you might ask? Well, Emancipation Day this year falls on Saturday, April 16th, which is observed on Friday, April 15th, pushing the due date to the following Monday, April 18th. Emancipation Day is a legal holiday in Washington, D.C., also making it a legal holiday for the IRS. So while the rest of the nation's taxpayers will file by April 18th, those in Maine and Massachusetts will have until Tuesday, April 19th, because those states have a holiday on April 18th, Patriots Day. So lots of holidays right around our famous tax return deadline. So, and just a reminder that the tax forms due on April 18th of this year will include the 1040, the personal income tax return form, the 1041, which is the income tax return for estates and trusts, and the 1120 for our C corporations. So if you need additional time this year to prepare your tax return, you may apply for an extension of an additional 6 months to file. So please be aware of a few things though. An extension of time to file does not grant you an extension of time to pay the taxes that you owe. It's an extension to file, not to pay. You should estimate and pay any taxes owed by a regular deadline, the April 18th, to avoid possible penalties. And you must file your extension request no later than this April 15th, this regular due date of your return. And then I also have some of the due dates here for your estimated income tax payments. If you are a taxpayer that needs to pay in quarterly, these are the dates for 2022, the 15th of April, only 2 months later in June, and then 3 months later in September, and then 3 months later in January 15th of 2023. All right, so I will flip to our next slide. So this is our first main topic tonight, income. And so I'll be discussing these points here on this slide. So gathering your records, gathering all of your records and making sure you have all of your income. The IRS issued a bulletin earlier this month concerning income and making sure you do these things before you file. Make sure you have all of your income. Make sure you have all of your income. Maybe you worked somewhere for 2 weeks. Maybe you worked somewhere for a month. They are going to send you a W-2. You don't want to file without these W-2s and run the risk of later having to file an amended return, which in terms of the IRS right now is a processing nightmare and can take months and months to process. So get it right the first time, get everything together, get all your income items and forms together. So make sure you have all of these documents again before you submit your return. So this is going to be your wages, bank interest. Maybe you earned some unemployment way back at the beginning of 2021 and you've forgotten about it. Don't file without these things. It's really, really important. All right. So I did mention unemployment. This was an extremely hot topic this time last year for a variety of reasons. Was it going to be taxable? Was it not going to be taxable? Was all of it going to be taxable or not? And was it going to be taxable in New York State if you got your benefits from the New York State Department of Labor? So a couple of important notes here regarding unemployment. It was announced last year in March, I think it was, that actually I remember St. Patrick's Day being a significant day for this topic, that for certain taxpayers, the first $10,200 of 2020 unemployment income would not be taxable. So this was last year. So it's important to note that this is not going to be the case for your 2021 tax return. All unemployment is fully taxable for federal and for New York State tax purposes. So all of your unemployment is taxable. That comes as a surprise to many people, we find out. So in terms of, there's going to be a tax document that's going to report what you received your benefits from unemployment. So, and in terms of obtaining this tax document called the 1099-G, it will show the unemployment from New York State you earned. And this is a website you can visit to download your New York State Form 1099-G. So this will take you to the Department of Labor website, right to the site where you can, I think you already probably have an online account with New York State if you had applied for unemployment and received benefits. We go back to that same website, which is right here, sign in and download your 1099-G and look it over to make sure it's correct and provide that to your tax preparer. So each recipient of unemployment benefits will have this form available online and will show benefits received and any federal or state withholding on the benefits received. Not as many people have withholding on unemployment as we like to see, but that's a personal preference when you start your unemployment benefits. Okay, so the next slide is back to talking about the IRS and some IRS letters and the IRS online account, which you may or may not have or have heard of. So the IRS website, I will say, has come a very, very long way. A lot of money has been invested in the IRS and the website, despite the horror stories that we are hearing from taxpayers and really each other, my colleagues, in terms of getting a hold of the IRS and just waiting on returns to be processed. Since the pandemic, it's really been extremely difficult, but we're encouraged, constantly to conduct our business on behalf of clients using the IRS's online features and services. Creating an IRS online account is the first step. This has presented some issues, to say the least, and I know the IRS is working on this constantly to try and make it easier for taxpayers and professionals. So at one point, you actually had to provide a selfie to a third-party service provider to help authenticate your identity, which was not an easy task for a lot of taxpayers signing up for an online account. So having a successfully established an online account with the IRS and having the ability to access really a lot to do with your personal income tax situation, including certain letters that you probably did receive or are even now receiving. I'm getting a bunch today from clients related to those stimulus checks. You can go online to your account and get copies of those letters, provided you have a lot of patience, I'm told, to get those letters and get that online account set up. So as I mentioned, the IRS 2021 has sent out 2 separate letters that your tax preparer will likely ask you for. We are certainly asking our clients for these. They're related to the amount of the third economic impact payment you received, whether it came in the form of a direct deposit, a check, or a debit card, and also a letter in reference to the advanced child tax credit payments. So those are going to be letters 6475 for the stimulus check, the third stimulus check, and letter 6419 for the advanced child tax credit payment. So I'll get into detail a little bit later on those letters, specifically in those credits. So we are, like I said, we're going to discuss those a little shortly. But in addition, on the website on this slide, speaking of the IRS online tools, this is a website called the IRS Interactive Tax Assistant. So if you can't sleep and you want to learn about taxes, you can certainly go to this website, and there's a really, really comprehensive list of tax topics broken down in very easy to understand language. And it can be very helpful if you're sorting through your documents and you don't know what to do with something, or you just aren't able to reach someone at that point. So it really is helpful, whether it's what's income, what isn't, how to claim dependents, and just really a host of other topics. So the IRS website, like I said, it really has come a long way. We use it constantly, all day, every day, to help taxpayers and tax professionals alike.
Hey, Lisa, I have a quick question that came in while you were speaking, if you have a second here. A question that came in said, I file using tax software.
Okay.
Last year was the first year I filed as a widow with only my income, but the tax software would not file just for this person. So the question was, she said she had to file a paper copy. Do you have any idea why? Is there something special about tax software?
I actually have had very similar situations with clients, and unfortunately, I thought maybe the question was going to be, where in the heck is my tax refund? Because I had to file on paper, which might be part B of the question. I have a client who's really in a tough jam. She is a widower also, and the issue, this is with our software, which is extremely robust, has to do with the Social Security number recognition. And it's thinking that she was the one who passed away when it actually was her spouse. So it's an absolute mess. So we ended up filing a paper form, and my poor client is just waiting since October still for her refund. And I'm told it's still going to be at least a couple months. So it's just really tough news to deliver to clients when that's the case. We have absolutely no control over it, but it's likely that it's a Social Security number issue. And I'm hearing that happen every once in a while, certainly with a couple of my clients for sure. So we will get into filing status in just a second here. So maybe that will help untangle some of it, some more about that question. Because filing status can be really tricky, especially when it comes to the widower and what year, can I still file jointly or claim, widower status. So hopefully that will help. All right, so we will move on to our slide here on the federal tax brackets and then on to standard deductions. So these are our 2021 federal income tax brackets. When people see these brackets and they imagine where their kind of income is going to fall here and what status they're at, they often wonder, okay, how can I get into one of these lower tax brackets and pay a lower federal income tax rate? So two common ways of reducing your tax bill are tax credits and deductions. Credits and deductions. So a lot of people don't know what the difference is between those two, and that's totally understandable. It's very, very confusing at times. So I'll talk more about these two topics very shortly. So I'll provide a couple important reminders on choosing the correct filing status. So we have our single status here in the first column, married filing jointly, head of household, and married filing separately. And we'll talk about the widower status as well, qualifying widower. So your filing status typically depends on whether you are single or married on December 31st of the year, which is really determines your filing status for the entire year. So if you got married on New Year's Eve on December 31st, you're considered married for the whole year. And I actually had a relative who did that, which is crazy. It was amazing. But yeah, so married on New Year's Eve, considered married for the whole year. Have had family, friends, clients do that. So pretty interesting. But the filing status affects whether or not you have to file a tax return, filing to claim a refund. The filing status affects the standard deduction amount, as you'll see in a moment, how to claim certain credits, and obviously the amount of tax you're going to pay here. So you are one of these filing statuses, maybe not from year to year, it might change, but you are definitely one of these filing statuses. So at 12/31, December 31st, the single filing status is appropriate for taxpayers who are unmarried, divorced, or legally separated under a divorce or separate maintenance decree governed by state law. The married filing jointly status is for married taxpayers who will file a joint tax return with their spouse. When a spouse passes away, the widowed spouse can usually file a joint return for that year. Married filing separately, married couples can choose to file a separate tax return, but we have, if you can envision a yellow caution symbol there, when doing so, it can result in less tax owed than filing a joint return or more sometimes. So in my experience, this involves a detailed analysis of the tax situation together with the spouse and then separately. So you're running a few different scenarios there and then really just kind of analyzing how all the available deductions and credits can be used or are kicked out and not available, which is often the case with the separate status. So we have the head of household status, where unmarried taxpayers, again, unmarried taxpayers may be able to file using this status, but special rules apply. The taxpayer must have paid more than half of the cost of keeping up a home for themselves and a qualifying person living in the home for more than half the year, at least half the year. Okay, then not on this slide, but qualifying widow or widower with dependent child. So the status may apply to a taxpayer if their spouse died during one of the previous 2 years and they have a dependent child. So the qualifying widower, the qualifying word means, you have to have a dependent child in order to use that filing status. Okay, so we are going to move on to the standard deductions. Again, this is broken down by filing status, and I have here the 2021 standard deduction amounts and 2022. So when people see these brackets, they say, wow, the filing status or the standard deduction amount is pretty high, and it's even higher for those taxpayers that are over age 65 and or blind. It really can get quite significant. So in many cases, you'll see taxpayers who used to itemize their deductions and they do not anymore and haven't since these changes came into effect, because the married filing joint standard deduction has really come a long way. It's quite high. All right, so now we're going to talk about the ever famous economic impact payments, EIPs, or stimulus checks, as they're called. So as you may recall from your 2020 tax filings, you may have reported the amounts of the stimulus checks or economic impact payments you received in 2020. There were 2 of them. So these payments were based on the last previous return you filed prior to 2020. So maybe your 18, maybe your 19 return. You may have received more than you should have, in which case you weren't required to pay anything back. So in 2021, the American Rescue Plan was signed into law. And with that came the 3rd round of stimulus checks, which were, for most people, $1,400 for the taxpayer, $1,400 for the spouse, so $2,800 for a married filing joint couple, and then $1,400 per qualifying dependent, as long as income was within certain ranges. So this is where this letter, IRS letter 6475, comes into play, which many clients received in January of this year, indicating the amount of the stimulus check issued to the taxpayer and the spouse. So your tax preparer might ask you how much you received for your economic impact payment, and in a perfect world, you as the client would just hand over to your tax preparer that letter that you received showing the amount that you got, and it was agreed with the amount that was deposited into your bank account or in the form of a check or a prepaid debit card. Unfortunately, we hear horror stories of a lot of clients who did not realize it was coming in the form of a prepaid debit card and thought it was just a credit card offer and threw it out. Rightfully so, completely understandable. And then it became extremely difficult to get in touch with the IRS on a phone number that was really not monitored by human beings. And it was really difficult and cumbersome to get that money back. So I wouldn't be surprised if there were questions rolling in about what do I do if I didn't get my money, but the IRS says I did. So that is a very specific individual tax questions, scenario specific to you. And there are a ton of really good frequently asked questions on the IRS website on this topic. And this is the link to get there if you would like to check that out. Or we can certainly talk offline if you have questions about that. So it's been a really tricky year or a couple of years for these payments.
Lisa, I put the link in the chat as well, so
Okay.
people can have that. So
perfect. Yeah, there's three sections of it. One is the first, one is the second, and then this one is specific to this 3rd economic impact payment. But if you don't have the letter, you still need to tell your tax preparer or your tax software what you received. If you really don't remember, if you can't recollect the amount, I often tell people, hey, go back to January and look at your bank statement, see what was deposited. Usually that is helpful, but this letter should have gone out and been received. And we were used to this from the year before to tell our clients well in advance, don't throw it out, stick it in your file with your other tax documents. We will be asking for it. All right, so we're going to continue on with some coronavirus related tax topics here related to income. So the CARES Act, enacted in March of 2020, provided for special distribution options from retirement plans and IRAs, certain retirement plans and IRAs. So some of you may have utilized this new IRS regulation at the onset of the pandemic. And so this is where up to $100,000 of distributions from certain retirement plans could be taken by qualified individuals affected by COVID-19. So we had some clients who were afflicted with COVID and needed some extra income to just get by or what have you. So anyone that was ill with COVID, supported a family member, household member that had COVID, had undue financial harm to their business or their employment, is basically an example of a qualified individual. So if the individual, this is called a CRD, a coronavirus related distribution. It's a long word, so I'm going to use an acronym. So if the individual took a CRD in 2020, which is the only year these were allowed, there is a lot of confusion there that this is still allowed, but it wasn't. It's only 2020. You would normally take that distribution into income. It's a retirement distribution. You take it into income, you pay an ordinary income tax on it. If you were under 59 and a half, pre-pandemic, pre-CRD rules, you would pay a 10% penalty on that distribution. But this is the catch. There was no 10% penalty on the distribution if you were under 59.5. The penalty was not in effect for these specific distributions. So the reason I'm bringing up the CRD, even though it was a 2020 benefit, is because tax, you could actually take this distribution into income ratably over 3 years, 2020, 2021, and then in 2022. So if I took a $100,000 distribution, I could elect on this form 8915E, which some of you might have had included in your tax return last year, take a third or $33,330 each year into my income, paying ordinary income tax on it, but no penalty for 2020, again in 2021, where you'll report that second third on form 8915F, and then probably going to be an 8915G for next year. They just keep increasing it in the alphabet there, E, F, and G. So of course, we have a new form, so it's this 8915. So you might see this form in your tax return if you took a coronavirus related distribution from one of your qualified retirement accounts in 2020.
We have another question. This question basically just asks if you would receive a form if you're not eligible for a third payment.
If you're not eligible for, an economic impact payment. No, you would not get a letter if you did not receive a payment. Is that what the
great.
question was?
I think so, yeah. It came in through the chat, so I think we're good.
So you would not get a letter if you were not. But that doesn't mean that, I'll just take it one step further. So that doesn't mean that you might not have been eligible for one. So the third economic impact payment is actually going to be reported on your 2021 return. If it was 0, and for some reason your 2021 income falls down into the range where you should have received a payment but didn't, because it was actually based on 2020 when the IRS estimated what your payment would be. So let's say you had a stellar year in 2020, but then your income dropped in 2021. The 2021 tax return has a mechanism called the recovery rebate credit. And it's a worksheet kind of that gets prepared behind the scenes that we see a lot, where the IRS will basically reconcile, here's what you got, here's what you should have gotten, and here's what you should have, here's the difference, here's what you should have received, and pay it out to you in the form of a refundable tax credit. But if the opposite were true and you shouldn't have got an economic impact payment because your income changed for the better, but you did, and there's no mechanism to repay the stimulus check that you shouldn't have gotten. So it was a non-taxable benefit to the fullest degree. So a little confusing, a lot going on over multiple years, and a lot of people that didn't get payments that the IRS thinks they did. And I could give a whole class just on that or talk endlessly about that, but I will not. Okay, so then we're going to move on to a really important topic, and this is deductions and credits. So these are ways to reduce your taxable income and tax liability. So let's delve into a couple related topics on income tax deductions and tax credits. Okay, so this is the standard deduction for dependents. I just want to spend a couple extra seconds on this. We get a lot of questions on this topic from parents. If you have a student and they're single, or if you are a student and single, you're usually required to file a federal tax return if any of the following apply. You have earned income, wages, etc., even across multiple employers that add up to more than $12,550, or you have unearned income, interest, dividends, capital gains of more than $1,100. You have to file a tax return. If another taxpayer can claim you as a dependent, your standard deduction is limited. So for 2021, the standard deduction for dependents is limited to the greater of, we have it right here, $1,100, or earned income plus $350. So the total can't be more than the normal standard deduction available for your filing status. So typically we see students and young people filing tax returns with income well below this $12,550 filing threshold, simply to apply for a refund of their federal tax withholding and occasionally New York State withholding as well. I'm going to skip the example and I can come back to it if there's questions, just to keep.
Yeah, quick question came in. This question says, I got a letter from the IRS that they paid me interest on something. Do I show that under regular interest?
Yes, regular interest. The letter they got is probably a version of a 1099 INT. So they would enter that interest on their income tax return. Probably interest paid and a refund or something of that nature. Okay, so we are going to move on to federal itemized deductions. So I'm going to just briefly review some important topics related to itemized deductions. There's a lot here. So I'll kind of key in on some that I think are important and that I see for our clients quite a bit. So itemized deductions are reported on Schedule A. They always have been. No form changes with that, thank goodness. It's in terms of what form that itemized deductions are. But if your itemized deductions as a whole exceed your standard deduction, you should itemize your deductions instead of taking the standard deduction. Okay, so first we have medical and dental expenses. So you can only deduct the part of your medical and dental expenses that exceeds 7.5% of the amount of your adjusted gross income on form line 40, line 11. So there are dozens of different types of medical expenses, as you can imagine. Prescription medications, in-home nursing help, Medicare Part D premiums, vision costs, mileage associated with driving to and from medical care at a rate of 16 cents per mile. A lot of folks don't know about that one. Okay, so a common question we get is, are expenses for PPE or personal protective equipment deductible? And that is definitely a good question. This is actually new for 2021. So your out-of-pocket costs for masks, hand sanitizer, sanitizing wipes for the primary purpose of preventing the spread of COVID-19 are qualified medical expenses, assuming they were not reimbursed by a health reimbursement account. All right, so then we have state and local taxes. This is the second section of the itemized deductions, second category. So this is for state and local taxes and is limited to $10,000. You can deduct either state and local general sales tax or income tax, plus your county and school taxes, but only up to the $10,000 limit. The $10,000 limit is finally referred to sort of as the SALT cap. It is a major hurdle, a major limitation for many taxpayers we see, especially those with high wages and high state income tax withholding. It is set to sunset in 2025, so we'll definitely be keeping an eye on that and whether or not the SALT cap will change. Very hot
question. Quick question just came in about expenses.
Okay.
What about hearing aids for those over the age of 64?
Yes, absolutely.
Okay, and I have
medical expense.
Okay, great. I have another question here too. Let me see if I can follow this one properly. Person says they received a letter from the IRS saying that they paid me interest, but I didn't see that money where I didn't see that money. Where would I find out where it came from?
It might have been actually automatically added to the refund that they received. So a tax refund might have been $100, and maybe the actual refund was like maybe $102, and they didn't question it because it was close enough to the original refund amount that they were expecting, but that $2 was actually interest. I don't know if the IRS would send a 1099 for $2, probably, but that could be the case. It was just tacked on to the actual refund. Okay, great. So the next category in our itemized deduction list here is interest. So this includes home mortgage interest, interest on a loan that is secured by your main home or second home. Many people ask about interest on home equity loans or lines of credit secured by the primary residence. This depends on when you took out your loan, how much you borrowed, what the funds were used for. Generally speaking, if the funds were used to buy, build, or substantially improve the home that was used to secure the loan, your primary residence, that the interest can be deducted, but not the interest on home equity loan proceeds that you use to pay off debt or put towards an emergency expense. The interest deduction also includes investment interest, which is interest paid on the money you borrowed that is allocable to property for investment. Okay, so our big chunk of this is going to be a discussion on charitable contributions, because there's a lot here that for 2021, again, like there was in 2020. You can deduct charitable contributions or gifts you gave to organizations that are religious, charitable, educational, scientific, or literary in purpose. Normally, you can claim cash contributions of no more than 60% of your adjusted gross income, but there's an even higher limit in place for 2021, which is 100% of your adjusted gross income. So often we have clients who utilized donor advised funds, and this is the answer to the question. Well, the question is, can they contribute up to 100% of their AGI to a donor advised fund? We get that question a lot, and the answer is no. Contributions to donor advised funds do not count towards this 100% limitation.
Another quick question that just came in. This question basically says, I received less back than I expected from the IRS, but no paperwork to show why. Can I find out what happened?
That's a great question. That depends. So yes, of course, you can find out what happened. I would advise just taking a deep breath and having a lot of patience when you start that adventure. I will probably sound like a broken record to my colleagues who hear me in my office talking to clients about, for those that like to, utilize the IRS telephone numbers, that ever famous 1-800-829-1040. Why can't I get through? Why can't I get to a human being? Well, it's the age old question, especially since the pandemic. It's really just, they are so short staffed and so short on resources that whenever I need to call them, I call them first thing in the morning at 7 o'clock when they open. Sounds crazy, but it literally works. I mean, it works beautifully. They are in their best mood of the day, especially if it's Friday. And I seem to get great service, from the folks that I speak to that time of day, that they haven't really gotten bogged down or behind yet. So I would advise trying the phone number, but calling at 7 a.m. Eastern Standard Time when the IRS opens for the questions to ask your question about your refund, why you didn't get it. Yeah, it could be any number of things. I can't even begin to imagine. Maybe there's income that you thought you claimed and you did not. Maybe there's gambling winnings that you forgot to report that were small, but enough to be reported. It could be just really any number of things. But if you're going to call early. That's my biggest piece of advice probably for this whole presentation. All right. So are we good there, Mike? Anything else?
Nope. I think that's it for now.
Okay. So we have a deduction available again in 2021 that was there in 2020. For charitable donations that are made in cash to qualified organizations, not in clothing or household items, for those taxpayers that do not itemize. So like I said, our married filing joint standard deduction is really pretty high. So we are seeing most of our married couples not itemizing, taking the standard deduction. But we also ask for their charitable donations because there is a $600 deduction that can be taken above the line or to arrive at taxable income, or I'm sorry, adjusted gross income of $600 for married couples and $300 for individuals. Not a ton, but I think with the standard deduction being so high and charitable organizations really taking a hit because of that, they're just trying to encourage some charitable giving to some degree. So again, this is for your non-itemizers and above the line deduction of cash contributions up to $300 for individuals and $600 for married filing joint taxpayers. Okay. Oh, I have another acronym, kind of like the one I spoke about before, but this is called the QCD, which is, you may or may not be familiar with. It stands for Qualified Charitable Distribution. So this is a distribution made directly by the trustee of certain retirement accounts or like IRAs. This is usually what we see, distributions from IRAs that are directly sent to qualified charities. The limit on these is $100,000 in a given year. So if all of the requirements are met, this distribution, this QCD, is not taxable. But on the flip side, you can also not claim it as a charitable contribution deduction of the amount transferred. So we're starting to see that a little bit more and more, qualified charitable distribution.
quick question. Going back to your great tip to call early in the morning. Just wanted to make sure that is Eastern time, 7 a.m.
Yes, Eastern
Okay.
time. Yes.
Perfect. Perfect.
Yep. All right, I'll just breeze through a couple more other itemized deductions. The big one here is going to be gambling losses. There's really not a lot of other itemized deductions available anymore. Gambling losses. So gambling losses can be taken as an other itemized deduction for itemizers, but only to the extent of gambling winnings reported on your 1040. Okay, so just a final note on itemized deductions. If you itemize for federal tax purposes, you do not have to itemize for New York State purposes. Most often we see taxpayers not itemize on their federal return, especially for married filing joint couples due to higher standard deduction amounts. And then they end up itemizing on the New York State tax return. So if that's happening to you with your software, or your preparer discusses that with you, that is definitely allowable. So I am going to the next slide. Okay, so now we have other adjustments and deductions, just a couple of quick updates here. IRA contribution limits, $6,000 for those under 50, and an additional $1,000 up to $7,000 if you're age 50 or older, or if less, your taxable compensation for the year. Thanks to recent tax legislation in 2020, there is no age limit on making regular contributions to traditional or Roth IRAs. And the dollar limits I just spoke about, the 6,000 and 7,000, they do not apply to rollover contributions. Then we have our ever famous educator expense tax deductions. This is the deductions for both itemizers and non-itemizers alike of $250 or $500 if married filing jointly, and both taxpayers are educators. And this is for unreimbursed qualified expenses. Qualified expenses are those you purchase for use in the classroom, and now also include amounts for personal protective equipment, disinfectant, other supplies used for the prevention of coronavirus. I don't have any teachers in my family, but I do have several clients and friends who are teachers, and they wish they only spent $250 a year on classroom expenses. They easily could double or triple or even more what they spend in a school year on stuff for their classroom. So I don't know why that hasn't increased in a very long time. So then we have our health and dependent flexible spending arrangements. So though flexible spending account funds and dependent care FSAs typically need to be spent by December 31st, many workers now have an additional 12 months to use their 2021 contributions to cover qualifying expenses. Congress changed this rule due to the COVID-19 pandemic because many households weren't using up their FSA dollars due to canceled or delayed medical appointments and procedures. Also along these lines are the health savings accounts. The 2022 contribution limit, so this year, is going to be $3,650 for self-only coverage and $7,300 for family plans. Lastly, the money you contribute to an HSA has no expiration date. You can withdraw funds you need to pay for everyday out-of-pocket health expenses, or save them for care you need later down the road. So HSAs, though, have to be paired with a qualified high deductible health plan. A little known fact about HSAs is that after the account holder turns 65 or becomes disabled, funds may be withdrawn for non-medical expenses without a penalty. A lot of people aren't aware of that. Okay, so here are the 2021 and 2022 contribution limits for several types of retirement plans. IRA contributions can be made until April 15th and are $6,000 for under 50 for traditional and Roth accounts, and $7,000 for those 50 and over, making that catch-up contribution. For simple IRAs, your employer contributions must be deposited by the due date of the return, including extensions, which is April 15th or October 15th upon extension. There are also catch-up contribution amounts available for those plans. And then there's some other limits here on 401k plans for both years as well. There's a bit more about Roth IRAs and income limits associated with Roth IRA contributions. The term phase out is often asked about and simply means a gradual reduction in the amount of the contribution that can be made, starting at $204,000 of AGI in the case of married taxpayers, and at $214,000, the taxpayers cannot make any Roth contributions. For single taxpayers, the phase out range is lower, starting at 129,000 and ending at 144,000 of adjusted gross income. All right, so definitely a robust topic here. Lots going on with federal tax credits in 2021 and 2020 as well, but we'll lots of things change because of the pandemic and continue to. So for these tax credits on the screen, I'll cover what's new with these credits as there are some significant changes, like I said. So as many of you are aware, the child tax credit is a credit available to taxpayers with qualifying children. Tax credit, as a reminder, reduces the tax liability dollar for dollar. So we all like tax credits. So for 2021, the child tax credit is going to be $3,600 for children ages 5 and under at the end of 2021, and $3,000 for children ages 6 to 17 at the end of 2021. During 2021, starting in July, many taxpayers, hopefully, began to receive advanced payments of the 2021 child tax credits, which are going to reduce the amount of the credit that you're going to claim on your 2021 tax return. So you still get the full credit for the most part, but you might have gotten some advanced payments of it starting in July of 2021. Some taxpayers knew about this and really kept it, stayed informed and decided to opt out of those advanced payments so that they would get the full tax credit on their 2021 return. But that process of going online and getting an account and identity authentication and everything was very cumbersome and burdensome due to the, like I said, that online account set up and getting through that identity authentication process. So again, just like the stimulus checks, it's very important to know that amount, if any, of the advanced child tax credits you received as your taxes are prepared. There's a form that will be completed in your return to reconcile the advanced child tax credit payments with the amounts that you received throughout 2021 and reconciled against the actual 2021 child tax credit that you're eligible to take. So unlike the stimulus checks, the 2021 tax return does contain a form or a mechanism for the child tax credit to be repaid if you received more in those advanced credits than you should have. So be aware of that potentially adding to your tax bill. So again, the advance payments were like the stimulus checks based on an estimate of what the IRS thought your 2021 income situation was going to be. Whereas the actual tax credit that's computed during tax time is based on your actual 2021 income. Kind of confusing, so please reach out to us if you have more questions on that. So now we're on to the child and dependent care credit, the second bullet. What's new here? So the American Rescue Plan of 2021 increased the amount of the credit for child and dependent care expenses. This is that daycare credit, in other words. So for 2021, you can claim the credit on expenses up to $8,000 if you had one qualifying child, or up to $16,000 if you had 2 or more qualifying children. The overall maximum credit is $4,000 if you had one qualifying person, or $8,000 for 2 or more. The more a taxpayer earns, the lower the percentage of expenses that are considered to determine the credit. So this is going to be computed on IRS form 2441. We expect to see a lot more families being able to claim this credit on their tax return because of the increases in the expenses and in the credit amount. And taxpayers that have higher earnings are going to be eligible for this credit more so than ever as well. So then we have the homeowner credit known as the residential energy efficient property tax credit. A lot of folks don't know if this is in effect from year to year because it's talked about being sunsetted and then it comes back. So always good to check and stay informed to get the most up-to-date information on some of these credits. Always submit your receipts even if you don't think the credit is available, just in case something changes that you weren't aware of. So this is going to be a small credit for the cost of energy efficient doors, windows, qualified natural gas, propane or oil furnaces, your hot water boiler, or certain circulating fans. There's some solar property in there as well, which we don't see quite as often, maybe because there's not a ton of sun here in Western New York, but that was not the case today. But the credit is anywhere between $50 and $2,000 and is claimed on form 5695. Be sure to provide your tax preparer with detailed receipts of these expenses showing the energy efficient status of that property. So there's lifetime limits in place for this energy credit. So you may have already used that up if you had a big installation of doors or windows in a particular year, or already used it for a furnace in recent years. There's a lifetime limit there. Okay, so on to education credits. So honestly, this is another topic that could be covered in a webinar all on its own. There's so much important information about these. What I will discuss briefly is the American Opportunity Credit. So this is going to be for your undergraduate students, and the Lifetime Learning Credit, which we often associate with our graduate students. For your 2021 taxes, the American Opportunity Credit can be claimed on amounts up to $2,500 per student, calculated as 100% of the first $2,000 in college costs and 25% of the next $2,000. So again, this is going to be used. The American Opportunity Credit is for undergraduate expenses. Can be used towards course materials, books, supplies, tuition, equipment, tuition and fees, but not room and board. So then there's the interplay with your 529 accounts, if you have any of those, and this goes for both types of credits. So if you withdrew funds from a 529 plan to pay for college expenses, you may not use these amounts towards the American Opportunity Credit. You kind of have to track your college expenses that you're using towards the credit and towards your 529 separately, kind of in two buckets. Just be aware of what the relatively low phase out ranges are for the education credits. Unfortunately, they're still pretty low. $80,000 is when of AGI is when the credit starts to phase out for single taxpayers, and $160,000 of AGI for married taxpayers is when the credit begins to phase out. We find that there are just a lot of clients who spend tens of thousands of dollars on tuition over the course of their students' lives, only to find out their income is just even slightly too high to allow for any federal education benefits, even the student loan student loan interest deduction. So then we have the Lifetime Learning Credit, which is a maximum of $2,000 based on 20% of the first $10,000 of qualifying educational expenses. There's no limit on the number of years of college for which you can claim the credit, mainly used for graduate or post-secondary courses, but not pursuing a degree. Lots of other educational benefits, too many to talk about today, including student loan interest, the legislation that has come into play during COVID on federal student loans and freezing payments and interest and everything, the use of Series EE bonds and 529 plans. Feel free to reach out to us with any questions on these items. All right, so then we have our New York State updates. I'll go through these really quickly. There's not a ton here. So I don't know how applicable this is to anyone in the audience, but we wanted to mention it anyways, just in case. It is brand new for 2021 for New York State. And it's the COVID-19 Family Death Benefit Program. This applies to taxpayers living in the New York City area, and allows for subtraction from income for any lump sum death benefit received pursuant to the COVID-19 Family Death Benefit Program established by the Metropolitan Transportation Authority. There's many other credits out there for individuals and businesses alike. Lots of different musical and theatrical production credits that have been extended or enhanced. We have the real property tax relief credit available for tax years 21 to 2023 on individuals with gross income of $250,000 or less, residing and owning real property for more than 6 months in New York State, have gotten a STAR exemption or the school tax relief credit, and paid property taxes. So it's not a very large credit. It's only up to $350, but just something to be aware of. If you see, if your tax professional asks you for any of this information, it's because of this new credit, and it's going to be computed on New York Form IT 229. So we talked just a few minutes ago about that $300 above the line charitable deduction for our non-itemizers and $600 for married taxpayers. This is not allowed for New York State, so it will be added back to your income for New York State purposes. However, the stimulus payments follow federal treatment and are also excluded from New York State taxable income. Okay, we are wrapping up here. I'm going to move on to our just a general topic on some important reminders on taxes and estate planning. Just some just a hodgepodge of kind of important reminders. First of all, important things to remember when choosing a tax preparer. So choose wisely. You're responsible for all of the information on your tax return. Ask about fees if they plan to use electronic filing, making sure the preparer is highly accessible and available for questions, even long after your return is filed for any issues that might arise. Check the person's credentials. Only attorneys, CPAs, IRS enrolled agents can represent taxpayers before the IRS in tax matters. Avoid return preparers who claim they can obtain larger refunds than other preparers. Avoid preparers who base their fee on a percentage of the amount of the refund. And always ask for referrals from friends and family members or from your attorney. Gifting, again, okay, so this is going to be one of those topics we're asked a lot of questions about, could be its own webinar, but just a couple quick points here in that, you're permitted to give another individual $16,000 in 2022 or $32,000 for gifts made by a married couple who agreed to split their gifts. The recipient of the gift, we're asked this all the time, does not pay tax on the gift. It's a really common question we get asked. The person making the gift, the donor, in other words, typically does not pay tax on the gift either, but will generally file a gift tax return just with information about the gift when the gift exceeds this $16,000 annual exclusion amount. So I would be remiss if I didn't mention the lifetime gift exclusion. This is the amount an individual can give during their lifetime without paying tax. Again, this could be an entire class, definitely in and of itself. So the gift tax form really just kind of helps track your lifetime gifts. In the event that you have a taxable estate, that kind of comes into play. Most of our clients don't have taxable estates since the filing threshold for 2021 was $11,700,000 and $12,060,000 for 2022. And that's when the need for an estate income tax return is an important matter to discuss, or an estate tax return. The estate income tax return is required if the estate generates more than $600 of annual gross income. So you might have brokerage accounts that are in the name of the estate, earning a little bit of interest and dividends that can add up quickly. Once that hits that $600 threshold, you're looking at the need to file a Form 1041 or an estate income tax return. The decedent and the estate are separate taxable entities. A federal tax ID number is required for the estate in order to file this estate income tax return. All right, so please reach out to us if you have any questions on this topic. We have many, many resources in this area to assist you. So kind of a topic near and dear to my heart, because I do really like to keep taxpayers and clients informed on this topic and checking up on your important documents. Normally I'd ask for a show of hands to find out how many people in the audience have a handle on their important documents. By those, I mean, ones that should never head to the shredder. In other words, such as your birth certificate, marriage certificate, social security cards, retirement accounts, life insurance documents, and wills and powers of attorney. Some of these matter most when you're alive and some after you're gone. When it comes to wills, powers of attorney, living wills, life insurance like term life or disability, and even information on your retirement accounts, you don't want your family members and loved ones to have to search high and low for these to find out what they should do with your personal property after you're gone. So, and if you don't have a will, it is time to get one. The rule of thumb is if you think you might need it in terms of an important document, if it's a personal identification document, if it's something that has to do with your finances, or if it protects your future, like life insurance or a will, then hold on to it. Keep it somewhere safe, somewhere you'll remember, and tell your loved ones where these documents are in the event that they're needed. And remember to shred documents with personal information on them before you toss it in the dumpster. You never know who could get their hands on it, unfortunately. Okay, so just a brief look ahead into 2022 taxes. Definitely have some question marks and a confused emoji there. Not too much change from this year, where there's just a lot going on and a lot of changes. Like I said, wait 10 minutes and you'll get a new tax law change. But so I'm not an economist, but I do want to unravel a little bit about how rising inflation, as we are seeing now, may affect your taxes. Inflation is rising quickly, and as we all know, and it hasn't risen as quickly since 1982. The IRS boosted the federal tax brackets for 22, standard deductions and more. As a result of inflation adjustments and other provisions, however, remain unchanged, leading to higher levies over time. So back to that educator deduction, the deduction for teachers and supplies that they purchase, that hasn't changed since 2003, for example. So some things change and some things don't. There's just so many moving parts here from a federal and state tax standpoint. Avoid surprises, lean on your tax professional, your tax advisor, and ask about getting a tax projection at least once a year. Stay informed. We tax professionals, we're really becoming accustomed to the constraints on the IRS and the need to be hyper aware of changes in tax rules, and sometimes overnight. Speaking of changing tax rules, my next bullet says more reporting. So one of the first things that comes to mind is another year of changes to the 1040 form. It's going to look the 1040 form doesn't look too different than last year, but we still have our schedule A, B, C, D, E, F, all those forms for different types of income and deductions. But we also have those schedules 1, 2, and 3, which are greatly expanded for 2021. There's really everything but the kitchen sink in there. So we appreciate your patience. We tax professionals, I'm sure I speak for my colleagues, we appreciate our clients' patience when we ask you for all different types of information that you're probably not used to getting asked for, all these advanced payments, your stimulus checks that you might not have been asked about in the past. So last but not least, stay informed, but stay informed and stay organized, which really just has so many benefits. This goes out to individual taxpayers, but even more so to our business owners of large, small, and even very small businesses, even our sole proprietors. A couple of pointers that we often share are have separate checking accounts for individual and business, your individuals and businesses, separate credit cards for your business accounts. Work with a professional considering hiring a tax accountant or CPA, one that is familiar with your specific circumstances or your craft if you're a business owner. Keep good records, keep all receipts and records of purchases related to your situation over the past year. Stay organized. Just by implementing a few practices into your daily, weekly, or monthly routine, you'll be ready to go when tax time arrives. And that is it for my presentation tonight. I hope this has been helpful and informative. Please don't hesitate to reach out with any questions or clarifications on anything I discussed. I know I went quickly. There's a lot to cover and tried to hone in on a couple of topics that we really thought our taxpayer audience would need to hear about this year as they're getting ready to have their taxes prepared. So thank you so much.
Yeah, thank you. If you could, Lisa, just to go to the next slide, just real quick. I think there's some information for people. So yeah, just first of all, Lisa, thank you for taking the time to do the presentation. For those looking for answers to questions and you just want some quick contact, we've established, like we do with all of our educational sessions, our text line. Just text the word tax to that line, 716-727-5047. We'll make sure that somebody follows up with you right away. So last thing I'll say before we sign off is that this presentation will be on our YouTube channel here probably within 24 hours. And we'll also send an email link out to everybody so you can rewatch it if you missed something, or maybe if you just wanted to revisit a topic. So on behalf of Lisa and Level Financial Advisors, I want to thank everybody, and everybody have a great night. Thanks.